Today, we will talk about how to make money from real estate. There is no quick way to make money or get rich in real estate, but you can grow wealth gradually and consistently by investing correctly. You are probably aware that there are numerous ways to accumulate wealth, but real estate is one of the most effective. 1. Making money in real estate by renting out property. This is the classic way of making money in real estate and getting rich. In this type of investment, you make money by leveraging long-term buy-and-hold residential rentals. People will always require a place to live. Lords and nobles fought over titles that let them collect rent from those living, farming, and otherwise working the land. A few entrepreneurial types drained swamps and built businesses so that they could make more from the land than they would if they merely leased it out to farmers and ranchers. We've come a long way in the intervening ways, providing many options for those who want to know how to make money in real estate. You may buy land, build a home, and then rent it out. You could find distressed properties, rehabilitate them, and then rent them out. Turnkey properties were purchased by someone else who rehabilitated them before finding a tenant. Regardless of how you acquire the property, it is a buy-and-hold strategy. You can own residential, commercial, and industrial real estate property. One of the biggest benefits of owning rental real estate is the steady cash flow it generates. It is the best form of owning investment real estate for earning a passive income. The downside of this approach is that you're putting all your eggs in relatively few baskets. If there are issues with the apartment complex you own, the rental income from it suffers as people leave or the repair costs eat into your profits. 2. Interest-based income through investing in mortgage notes. Mortgage notes can be a good real estate investment for people seeking passive income. When you buy a mortgage note, you receive monthly payments that include both interest and principal. It is a steady stream of income like you'd receive from a rental property, but there is no need to maintain the property like a landlord. It is far easier to invest in real estate located around the country because you don't have to deal with local rules regarding real estate licensing or taxes. The mortgage note spells out the loan duration. You know how long you'll receive loan payments, and it may be 10 to 30 years. You may be able to increase the value of the mortgage note by buying from a distressed note holder. For example, you may find a farm or family property sold via owner financing. The person sold their home, but now they have to manage the loan. They may need the money, whether it is to allow them to buy a new home or simply get cash to fund their retirement. In these cases, you might offer $80,000 to buy a $100,000 note. If they accept, you receive the interest and principal on a $100,000 loan, but only pay $20,000 for it. 3. Getting rich by flipping real estate. This is another proven way to make quick money in real estate to get rich. Fix and flip is a specific form of real estate investing. The investor buys a home, pays for repairs and renovations, and then sells the property for a profit. This type of real estate investing is the subject of numerous reality shows. The reality is that this form of real estate investing is high risk. If you've underestimated rehabilitation costs, you could lose money. If you put too much money into the investment property because you don't understand your target market and buyer expectations, you've probably wiped out your real estate profit margins. Whether there are problems with the selling price, the real estate agent, the neighborhood, or how the property looks, every month the house sits on the market subtracts the property's carrying costs from your profit margin. If you try to do the repairs yourself to save money, the theoretical savings on labor costs are offset by the delays in getting the property to market. If you're not already a skilled building contractor, there is a risk that DIY repairs don't meet the code or potential buyers' expectations. Then you may lose everything on the deal because you have to pay for someone else to redo what you thought was done. The ideal fix and flip is a property that only needs cosmetic repairs, but these are truly rare. 4. Making money through real estate investment trusts. Real estate investment trusts, or REITs, allow you to invest in real estate without having to buy and manage a property. REITs may be invested in mortgages, properties, or a mix of both. You can diversify your holdings in real estate by buying REITs invested in particular market niches. Because REITs are publicly listed, you can buy and sell shares on the open market, making your money more liquid and allowing you to diversify your investments. One of the benefits of REITs is their non-correlation with other types of equities. This means that the value of REITs depends on the real estate market, not the stock market. REITs are available in publicly traded and non-traded forms. The Securities and Exchange Commission recommends against non-traded REITs due to their high fees, the challenge of liquidating them, and the risk they may become worthless. Publicly traded REITs are as liquid as stocks and bonds. REITs stand out for their regular payment of dividends, something that a decreasing share of stocks offers anymore. Clearly, this also shows a way to make money in real estate and get rich. 5. Making money through real estate ETFs and mutual funds. You can buy exchange-traded funds, ETFs, and mutual funds that are broadly diversified or targeted to a particular sector. And you can buy ETFs and mutual funds that are themselves invested in real estate. For example, it is possible to buy ETFs that invest in real estate stocks such as publicly traded home builders. Some ETFs invest in REITs as well. There are mutual funds that invest in real estate developers and property management firms. Both investments are handled by a fund manager, ETFs are passively managed, and mutual funds are actively managed. ETFs are less expensive than mutual funds, and you can trade them like stocks at any time during market hours. The benefits of investing in ETFs and mutual funds include high liquidity and low costs. Forget cashing out your 401k or 403b plan to buy rental real estate, since this strategy allows you to invest in real estate within tax-advantaged retirement accounts. You don't need a lot of money upfront to start investing this way. Conversely, you may not receive dividends. You may not receive any returns until you sell the appreciated shares. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.